Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. Another fine week. Looks like a little cloudy out there. I guess it's supposed to blow over a little bit later. That would be good. Oh. Anyway, like the guy said, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can also catch us on iTunes, Bullington Capital Report. You can catch us on a bunch of different places around the internet. So if you just want to Google that, that would be fine. And I guess I'll start off like I do every week by talking about the upcoming workshop. In fact, I've got to go to it because I can't even remember what date it is. You'd think I would know that pretty quickly, wouldn't you? But that's what happens when you do a lot of them. And we do a lot of them. In fact, we'll probably do one about every 6 to 8 weeks. Just get out there, get some of this information out there that people need to be hearing. Okay, this one's on September 14th. So September 14th, we're going to start at 6:30 because that's the official time. We're going to run through Stock Picking 101. That's going to be the first part of it. And it's basically how do you identify a halfway decent company. And then we're going to talk about the 10-minute retirement plan. We've got some new tools at Bullington Capital. In fact, we're actually still in the process of learning them. In fact, the learning portion of this never ends because they keep changing stuff around, first of all. And secondly, there's a lot to know. But when rules change, software changes, you've got to go back and study. So we're going to show you a lot of the things that we're doing now. It's I think it's a great service, the 10-minute retirement plan. If it takes you more than 10 minutes to figure out what kind of income you can generate relatively safely during retirement, then you probably don't know what you're doing. That's my opinion. And you can come and find out why at the workshop, because it is relatively simple. So go to the website, Bullington Capital, sign up. There's a seminar tab there, or you can call us. 330-664-0700 is the office number, 330-664-0700. And I will leave that. We'll come back and revisit this a little bit later in the show if you want to talk about those things. You can always bring whatever questions you have there. You can also send us questions. Website, the email. If you go to website, there's a contact us form there. Just type it in, send it. We'll be glad to answer it. But again, it's the 10-minute retirement plan and Stock Picking 101. Should be a lot of fun. We're going to go at 6:30. We're going to do Stock Picking 101. That's only going to last for about 45 minutes. The same thing is true with stocks. Picking stocks is a lot simpler than most people think it is because we all have a tendency to want to overcomplicate things, not just in the stock market, but in most of our lives. And it's not as complicated as you might think. But it probably doesn't work the way most people think it does. The vast majority of people think that the stock market is logical. And occasionally it is. And a lot of the time it's not. And that's what confuses everybody. The stock market is not a logical place. And what do I mean by that? Well, you can actually have investments that underperform for years sometimes. For years. But if they're based on something sound fundamental theory, sound facts, then over time, they have a tendency to catch up. Those strategies have a tendency to catch up and then push ahead. And I've got tons of examples of that. In fact, I'm putting out some, I've been writing for years on stuff that I haven't published. And that's one thing I'm going to do this year. A lot of the stuff that I haven't published, I've got literally probably 1,000 articles that nobody's ever seen. Because I get them done and then I'm not happy with them. So I'm just going to start putting them out there anyway, because this is stuff that, people need to hear it. It's going to help some people. It's really going to help people. Investing is a very important part of your financial plan. In fact, it's right up there. If you ranked the order of importance on a successful financial plan, number one would be learning to live beneath your means, not within your means. It's beneath your means because you're going to have to save something. So once you learn how to do that, and by the way, everybody's different. Some people save and scrimp and save, and we call, some of these people that tendency, the squirrel gene. Somebody's along the line mated with a squirrel because they like to go out and save everything, and that's good. I mean, that's good. I think you can overdo that, but it's good. I'd rather somebody have that characteristic than the opposite, somebody who spends more than they earn, because that is not good. It's very difficult. So during the workshop, we're actually going to talk about that, how you arrive at what you would actually need to be able to support your lifestyle. And I'm here to tell you, it's not as hard as you think it is. It's just not. People love to make this much more difficult. They love it. They start thinking about all kinds of things. And what happens is fear starts creeping up in their minds, and they start creating other scenarios. And you know the routine. Everybody's done this, not just in their money either. I mean, it goes throughout almost every facet of your life. Fear creates a lot of wandering thoughts, big thoughts, sometimes dark thoughts, and then you just put it out of your mind to try to forget it. And very, very similar to the rest of your life. And there's not I haven't found a lot of information or material that explains things quite that way. And I was going through this marketing course recently, and this guy's describing something he called a superpower. What is your superpower? And he's requiring that everybody go and get that. And I really hadn't thought too much about that, quite frankly. And when I was thinking about it, I was going, wow, you know what? I think that what I try to do is break this down into something that's relatively simple. Take the big picture. What are the most important parts? What are the highest priorities? And then explain those in English. And I think that's what I don't know if it's my superpower or not, but it's what I try to do. Take the big concepts, the ones you've got to get, and then break it down in English. And I see a lot of people really frustrated over trying to figure something out that, quite frankly, you'd have to have a crystal ball that works to be able to do. And, they have a lot of frustration, and I feel bad for them. You have to give some of that up. Like, you can't really know exactly when you're going to die. That's a hard thing to do. You can't know what the tax rates are going to be 10, 15 years from now. You can't. You can take a guess, and that's okay. It's okay to take a guess, but you can't know that for sure. So there are a lot of things that you can't know for sure, and you've got to try to figure out what those are. What are the most important ones? And then how do you deal with the uncertainty? And a part of that, I'll give an example. There's a lot of uncertainty in stock market moves. They go up and down a lot. They're extremely volatile. If you don't have a plan for handling that volatility, the volatility is going to handle you. And it doesn't handle you gently. So you've got to have a plan to handle the volatility in the market. And right now, if you're approaching retirement or you're already retired and taking money out of your accounts to supplement your income, then you really need to pay attention to what I'm about to say. And what I'm about to say is you can't afford not to have some of your money in stocks. Now, having said that, I guess I should say for the vast majority of the population, if you've got $100 million and you're only spending $5,000 a month, hey, no sweat. But if you're in a position where you have to withdraw somewhere around 4 or 5%, maybe even 6% per year, you've got a problem in that if you put all of your money in stocks and you're taking that kind of money out, you may end up going back to work in retirement or having to cut back significantly on your lifestyle. And you don't have to do that. You don't have to do that. And I'm going to show you that. That's going to be part of the 10-minute retirement plan at that workshop. And I am working on a little ebook. I've been working on a lot of these things forever. Like I said, I've got lots and lots of articles. This one I am going to get out before the next seminar. So before September 14th, there's going to be a little ebook that's explaining this, because I feel really bad for the general public who's heard all this stuff, and the marketing ploy for an awful lot of businesses is to confuse people with a whole bunch of data. And eventually, if we can get them to call us, then we can confuse them a little bit more and get them to sign here. I don't like that. I'd rather be upfront. Hey, we're all adults, hopefully, and let's just face the facts and see what we have to do. And the facts are, if you're going to be taking out somewhere between 4 and 6% in retirement, you're going to have to invest in stocks, or you're going to have to know exactly when you're going to die. Then you could actually do that too. If you knew exactly when you're going to die, we could plan it out to the penny. But that's, assuming that we don't know that, then we're going to just plan on living. We're going to plan on living forever, incidentally, because most people, now not all people, but most people would like to leave something behind for the next generation, or there's a charity that they like, or a foundation. And because you don't know exactly when you're going to die, then you should plan on living forever, at least having your money live forever. And if you have it's not that hard. Let me give you a really simple example. If you kept 5 to 10 years worth of your money in short-term treasuries or CDs or AAA rated bonds or AAA rated tax-free bonds that are short maturities, okay, not long maturities. You don't want to be holding long maturities in this interest rate environment. I'll get back to that in another show. But short maturities, are you going to make a lot of money? No, you're not. You won't make a lot of money on those types of investments. We're buying them for their safety, because this is what you're going to use to live on while you take the rest of your money and you invest it into stocks, diversified stock portfolios. This is investing 101, except that I've never seen it. I never saw it in any of my finance classes when I was in college. And you need to know this, okay? So taking the money that you're going to be withdrawing, keeping it invested in short-term treasuries. I typically keep about 5 years worth. So if you've got 4 to 5 years worth, minimally, into short-term treasuries, and that's what you're going to use. That's what you're going to liquidate, okay? Because it's not going to fluctuate very much, very little, if at all. And you can count on that. Now, the more conservative you are, let's say you say, I don't have that much faith. Maybe I'd like to put enough money for 10 years. Okay, that's not a problem. If you're going to take out 5% a year for 10 years, we need roughly 50% of your money in short-term instruments like CDs or treasuries. And I have an ETF I use. It's SHY. It's super short-term treasuries. And that's where we're going to take the money. We're going to withdraw that and spend that down over the next 10 years. But each one of the years, we're going to look at the total balance. If we have a really good year, we're going to rebalance. We're going to take some of that profit that we just made and move it over into those short-term treasuries or the equivalents. And if you've had a bad year, you just hang on because you got 10 years worth of money there. How awesome is that? How simple is that? Come and see it at the workshop. I'll actually have numbers for you. I have a little illustration of somebody who might have done that. And I think it's a very simple but effective tool, a very simple but effective way of taking all the precautions that you can to ensure a comfortable retirement and a steady income. That's kind of a key, that we can take this money out. Are we assuming risk? Yes, we have to assume a little bit of risks. You got to assume some cases. It depends on how much money you need to take out and what your age is to determine how much risk you should be taking. And we have a questionnaire for that too. I'm going to give one of those out to everybody that goes to the workshop. It's free. You can fill it out and we'll run the numbers for you and send it back to you in an email and tell you what kind of investor you are. Yeah. How cool is that? And there's no charge for that, by the way. This whole thing is free to the public. So, but the seating is limited. I think we've got 88 seats left. And you can go to bullingtoncapital.com to sign up for that online. If you have any questions, you can also call us, 330-664-0700. You can actually call here during the day. I've been during my show, 216-941-0945. 216-941-0945 is the radio station's phone number here. So if you have a call regarding or a question regarding anything that you've heard on this show, it doesn't have to be that either. It could be any question that you have. Just give us a buzz, and that way I don't have to sit here and talk to myself for an hour straight. Yeah, which I've been doing for an awfully long time. And it's kind of fun. But I've never really had an argument with myself, so that's good. That ever starts happening, we might be in a little bit of trouble. But anyway, I think we're getting fairly close to a commercial break here, and we'll talk about some other topics when we come back. I thought it was pretty funny that there was an article that ran in one of the business publications that I get that was talking about the bomb shelters that were selling like hotcakes in Japan because North Korea's rattling their saber. What won't these guys publish? Just to sell a couple of newspapers or magazines, get the hits, get the clicks. It's pretty wild. I don't know if it's true or not. But it was in a fairly reputable publication. I'm going, wow, these guys are really hurting for advertising revenue. So anyway, we'll be talking about a couple of those things when we come back from these commercial messages, but which are going to start in a couple minutes here. And there were also there were a bunch of articles this week. For some reason, some really interesting stuff came out. One of the articles was on how there were 10 major automobile manufacturers around the world who were all getting ready to roll out a hybrid vehicle. That's some of them were running on hydrogen that was extracted from natural gas. Now think about that for a second. We got a ton of natural gas in America. I mean, a ton of it. We are the Saudi Arabia of natural gas in the world. And if these guys go to the type of car that actually Toyota's already got and is selling in a lot of in California, they're fuel cell cars. They're hybrids. They generate electricity for themselves. And they run on natural gas. Well, actually hydrogen that's been extracted from natural gas. If that were to catch on, like really catch on and move across the country, now you've got 10 major manufacturers that are building some sort of vehicle like that. Boy, does that change things. It's actually going to be very good for GDP growth. It'd be incredibly good for GDP growth. It'd be great for the auto manufacturers to build those vehicles. Anyway, now that I hear the music, it is time to go to commercial break. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned because I'll be right back. And we're back. Hey, I got to go to the phone right now. I've got Daryl. Daryl, you're on the Bullington Capital Report show. How are you doing?
Morning, Mr. Bullington.
Hey, what's happening?
Or as my Amish friends say, good forenoon.
All right, I'm not sure I know
I'm
what that
well.
means. That's good.
I'm well. Thanks for asking. I have a general question that is probably elementary for you, but I need to get the perspective in my own brain. As the money poured out of equities this past week, where did it go? Where did the money go? Did it
Goes to cash.
go proportionally into commodities and cash and what's the general pattern there?
Well, see, here's the problem. You're looking for a general pattern, and you've got somewhere around 30,000 legitimately large funds out there. They're not run by individuals. Okay, they're run by management teams. And so you've got to go and you've got to take a poll of all those people. It's roughly a couple million, and find out why. And by the time you get that poll done, their feelings will have changed. So you can ask those questions, and it's fun to wonder why. I would not beat yourself up over it, trying to figure it out, because quite frankly, you can't. You just can't.
There seems to be kind of a direct relationship between decline in equity value and increase in commodity value.
No, that correlation doesn't stand up.
No?
Statistically, it's not a good correlation. Correlation's not the same thing as causation, by the way, either. So you want a cause and effect, not a correlation. Correlation can be just a happenstance, So, but there needs to be a fundamental reason for moves to occur, and that's one of the mistakes a lot of big data guys make is they look at correlations as if they exist. Well, there was this thing called a Super Bowl theory that was actually way better and more accurate than 90% of the analysts out there on predicting what the stock market was going to do a year in advance. Okay, and then when they moved when the league changed, its effectiveness has dropped significantly, and it had nothing to do with the stock market. So you can look for, and people do that all the time. That's probably one of the bigger mistakes I see individual investors who are maybe slightly more sophisticated. When they start looking, they're looking for correlations instead of the causations. And you give a really good example of something that had happened back in the early 70s. There was a group of Nobel Prize winning economists. They got together and decided that, hey, we're so brilliant, we're going to create a hedge fund, and we're going to manage that fund and get really, really rich. And for the first couple of years, they did extremely well. The next few years, not only did they lose all the profits, they lost half the original principal. Okay, so they finally stopped and said, hey, we're going to have to change our methods here. Obviously, our forecasts, even with our Nobel Prize winning research, are not very good at predicting the future of these commodities prices. So they started this thing called trend analysis. You've probably heard that before. Their performance, so what they did was they said, look, we know what we think is supposed to happen to the price of cocoa, but let's wait for it to start moving in that direction before we get on board. And when they did that, their performance shot way up, and these guys did get super rich. Okay, and then they shut their fund down and just took their millions and invested in treasuries and lived life. And that's what happened. So what they did was they were looking for, they had the fundamental side down. They knew what they expected to happen. But they would actually wait for price confirmation that the trend would actually change, because if they don't wait for that, they were going broke. They were losing the money that had been entrusted to them. So to me, that was a huge lesson, and it has had a big impact on me. And I can tell you this: when you are in a trendless, choppy, volatile market, that does not work either. And if they were doing that again today, which a lot of them, there were still a lot of funds out there that do, their performance is actually flat or negative over the last 4 to 5 years. And I don't doubt that at some point in time that comes back, because this is not the first time that those cycles have happened that way. So at some point in time, I know it will. They're printing money so fast that sooner or later, you're going to get a pretty good bout of inflation, and commodities are going to be the place to be. But wait until they start moving. And then you better have a close stop to get out and a profit-taking methodology as well. So you've got to have a complete plan to participate in that. And by the way, there are very, very, very few funds that are run that way, mainly because a lot of them have shut down because the past 4 or 5 years have been so hard on them. But there are some funds that do that, and unfortunately, you got to have a $2 million minimum net worth to invest in them. Yeah. So I would tell you that a diversified stock portfolio is the way to go for the next 4 to 5 years, minimally, and probably for the next 10 years. And it all depends on how things play out. Right now, you hear a lot of noise about the stocks being overvalued. Well, some of them are, but a lot of them aren't. So the ones that are overvalued are the ones that have done the best over the past 4 to 5 years. And that's where those funds, by the way, are the ones that are receiving all the new money. People are chasing that past 5 year performance when you really should be looking at, okay, which ones have underperformed but have a good long-term track record? If they got a good long-term track record and they've underperformed for the past 4 or 5 years, that's what you want to be paying attention to. And that's actually why that Department of Labor model is actually going to work well over the next 4 or 5 years. And it was luck on their part. By the way, now they're talking about repealing that thing. What? Yeah, after all this effort? I had to take all these classes, buy all this software, and but I'm glad they did because the categories that have underperformed, I think they're going to catch up. They'll close that gap. The ones that have outperformed for the past 5 years, probably sideways. At least I hope they go sideways, because if they keep going up, then you're going to get a big crash. And it's nothing to try to avoid or anticipate. You avoid it by having exposure into the other asset classes and then rebalancing your portfolio. Something else what we're going to talk about at that workshop. But anyway, make a long story short.
Well, I'm planning on being there. And I'm glad that I've got you watching this stuff for me, because some of the things you're talking about are over my head.
So, well, thanks.
I'm so glad that you're so good at this.
I appreciate that. You want to plug your website?
Yeah. Tell people to go take a look at nutriskis.com. N-U-T-R-I, as in nutrition, and skis, S-K-I-S. Nutriskis.com.
That sounds good.
And they can find out about that basic H on that little tab that says Shop Now.
Yeah, I love that stuff. That it's wild. It's a great general household cleaner. It's not, when you look at how long that lasts, a little bottle of that, and how much it lasts, it's actually a pretty good deal too. So anyway, basic H and nutriskis.com.
Yeah, we've got a kit of products that runs about $100 that replaces over $1,000 that you'd spend at Mark's for cleaning products.
Oh, awesome.
Yeah, comes with all the spray bottles and everything you need to mix it up. So people sometimes are a little bit lazy and they like to buy something off the shelf that they can just pull the trigger on the spray handle. Some of this stuff you've got to measure out a little bit, but it's well worth it because of the savings.
And it's fast, too.
Biodegradable.
Yeah. Yeah, it doesn't take long.
I'm telling you got to try shaving with it, man. It's unbelievable for shaving.
I will. I'll try it on Monday. I'll get some out, try it on Monday.
You're not going to shave tomorrow.
Yeah, no,
okay.
I don't shave. Well, yeah, I guess I do shave on Sundays. But yeah, maybe I'll try it tomorrow. So anyway, have a good weekend.
Always enjoy speaking with you. Have a happy day, my friend.
Thanks. You too. Bye-bye. If you'd like to call 216-901-0945, 216-901-0945, and yeah, I hear a lot that stocks are overpriced. Certain stocks are overpriced, but they're not crazy, insanely overpriced the way that the housing stocks were or the banking stocks were in 2006 or in 1999, like the technology stocks. You don't have that kind of thing going on. And the overvaluation there could be handled a couple ways. Might be the Band-Aid approach. Maybe it comes down pretty quick, pretty fast, gets to a cheap, good level, and starts to go back up, or they could just kind of channel sideways for quite a while. And while some of the other categories that haven't performed quite as well catch up. And that would be my preferable way, particularly with the portfolios we have. But it doesn't really matter. That doesn't really matter how that plays out. And that's another thing we'll be talking about at the workshop, and I'll be probably talking about until I die. If you know that large, medium, small companies tend to perform very similarly over time, and but they don't do it at the same time, what's the logical thing to do? Now, an awful lot of people think that the logical thing to do is to try to forecast and predict which one's going to do best. Well, that is incredibly difficult to do, and I know there are a lot of services out there that'll tell you that they can do it, and I haven't found a single one of them in the last 30 years. It's been consistent, not one. Some of the ones that actually worked in the past don't work anymore. So if you're going to use something like that, you've got to track its performance over time, and you can't just say it's had a bad 6 months, by the way. That, market's up 8% and you're flat or slightly negative, that's nothing. That means nothing. That is not a significant statistic. You got to go over a full market cycle, minimally one, and even then it's not a foolproof thing. So that's what makes this so hard. You look at something, you think it works, and I've seen a lot of people show me something that happened to work 4 times in a row, and they think that they're onto something. And I just tell them to flip a quarter 1,000 times. If they want to do themselves a favor, flip a quarter 1,000 times. If you flip a quarter 1,000 times, it's going to come up heads or tails at least once, 5 to 10 times in a row. Now, if you were looking at something, happening 4 or 5 times in a row, how does that make you feel? Your chances are 50-50. So you want to be, it's got to be based on some sort of sound theory and not just a correlation, not just something that had happened in the past and you don't really know why. If you don't know why it's happening, that's kind of what those Nobel Prize winning economists learned. If you don't know why something is happening, okay, then you should probably just stand aside, which is what they were doing. They were standing aside once they learned that predicting was not a good way to make consistent, reliable money. And incidentally, there's not a good way to make consistent, reliable money. It doesn't work that way in financial markets. And that's another thing that's really popular for people. They go around looking for something like that, and they're going to be disappointed. But the alternative is actually very good, and I think most people can put up with it. When I say put up with it, I mean fluctuating stock prices. So how do you put up with fluctuating stock prices? Well, it's relatively simple in my mind. We've just got a little 7 questionnaire. You fill out the 7 questions, and basically it'll tell you how to break down your investments between stocks, bonds, cash. And then we have recommended exposure to various asset classes that's going to be affected by your age. It's pretty simple. So that process for us is very simple. We've been doing it for a long time. I can tell you, if you didn't want to go through all that, here's what I would do. Take whatever of a decline that you could put up with in your portfolio, multiply it by 2, and that's what you would put into your stock portfolios. Now, I'm talking baskets of stocks, whether they're mutual funds, exchange-traded funds. You don't want to go out and pick your own stocks if you haven't been doing this for an extremely long time period. But that would give you the breakdown of the percentages that would be pretty close to the answers you're going to get, or to the model that you would get if you did the more elaborate, it's only 7 questions instead of 1, Morningstar questionnaire that we use. So it would be very, very close. And then you pick your stock strategies, which ones you like, which ones have a decent track record, and you want to look at the risk-adjusted return, not just the return. The highest returning stuff is incredibly volatile. Almost nobody ever makes it through that when they have a down period. So you want to look at the risk-adjusted returns, and there you go. So let me give you an example. Let's say I got my decline tolerance set at 40%. I'm willing to be down 40%. Why am I willing to be down 40%? Because I want to make a lot of money. That's basically it. I feel like I'm young enough and I can survive and recover relatively easily if I'm down 40% at some point in time. So I take 40 multiplied by 2, that is 80. I could put 80% of my money into diversified stock investments. If I got another period like 2007 through 2009 that came along, which doesn't happen that often, thank goodness. But if I did, I'd be down about 40%. And I'd still be okay with that. And actually, I would be scratching around looking for some money to add to my holdings at that point in time. But that's me. Not everybody's like that. Some people have a 15 or 20% decline tolerance. And if that's you, you multiply that number by 2. 15 times 2 is 30. You're going to be 30% stock, 70% fixed income. I will tell you, you won't make much money if you do that, because having only 30% of your money into stock strategies is not a lot. But if that's all you can tolerate, then that's what you got to do. If you were a 20%, that's a 40% allocation to stocks. Now, how simple is that? Super simple. And it's simpler than the Morningstar questionnaire. Unfortunately, my questionnaire hasn't been improved by the Department of Labor. Mine is just as good. I promise you. I've done the math. I've run the simulations through the computer. Works very well. Now that I hear the music, we're going to have to take a quick commercial break. You're listening to Bill Bullington. I'm here on 1420. Stay tuned.
It's my favorite thing.
And we're back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. At some point in time, I think first part of next year, knock on wood, we should be simulcast on an FM frequency, so that'll be nice. Also, you can find blogs, I'm on the archives of this show on iTunes, or go to my website, bullingtoncapital.com, and you can sign up for the upcoming workshop. We're going to be talking about Stock Picking 101 and the 10-minute retirement plan. And that's bullingtoncapital.com. There's no cost to attend. Seating is limited. Going to be basically, we're going to talk for 45 minutes, take a 15-minute break, talk another 45 minutes, answer questions, and I'll get you out of there. And it should be a pretty good time. And you can always email us, too, if you have questions. Feel free. You can either go to the website, click on Contact Us, and fill out a contact form. Or you can just go there, and our phone number is always there. You can call. And we'll try to help you. The road that we've traveled down throughout the last years, it's been very interesting. And I think we've got so much more experience now in helping people really try to set those goals and try to reach those goals, whatever those goals are. And it's not as complicated. I'm telling you, it's not as complicated as most people make it seem. I'm not going to tell you that it's easy, but it's just not that complicated. So there's a difference between hard and intellectually difficult. Yeah, something that's intellectually difficult and hard, that's a bear. That would be somebody who designs and builds semiconductors. Yeah, but fortunately, this is not it. Personal finance is nowhere near as complicated as the things that I see people saying and writing about, and I'm very grateful for them because they present the opportunity for people like me to come in and help people. So again, you can go there. We offer a complimentary Get Acquainted meeting. We do it on the phone, over the computer. We've got a new service that we're rolling out that actually I'm going to be in training on this week. And it allows you to go in and track your investments. You can track the accounts that we have. We use 2 different custodians, my firm. We can pull those in on one place. You can see the holdings, your cost basis. It's awesome. You can add to it anything that you want to see. So if you want to track your spending, and I do this, which has been really nice. I've got an alert set that anytime an expenditure goes through that is above a certain dollar amount, they send me an email. And there's a summary at the end of the week that they send me. So all of my clients are going to have access to this. We've been trying to talk to them on a one-by-one basis. New clients coming in will have access to it. And we're trying to figure out how to do a mass mail. We haven't figured that out yet. The service is too new. We would like to set out a mass mailing to all of our clients to say, hey, watch your email because you need to set up a password and user ID. And it's a really good tool. Keep everything in one place, keeps you organized. That's one of the big things. I don't know what we call it, a big idea, I guess, but one of the main ideas behind becoming financially successful is setting the goals. That's you really need to do that. You need to sit down and spend a little time, try to set some goals. If you're already at retirement and it's not as important that you set goals, then what's important is how much income do you have and what in the way of assets do you have? Those are the 2 driving factors behind how much lifestyle can I afford. Okay, but before you hit that point, if you just set down some basic goals, what does it take to replace my income? We can put up a retirement plan, and it's going to be on that site as well. And everybody that comes, I'm going to show you how we do that. Are going to be doing that going forward and into the future. So you can go back to that website and you can check to see how you're doing. And it's reminding you at least once a week what your progress has been. So I think that it is just awesome. I can't believe that we have access to this type of technology today. And it's mind-boggling. And I know there are a lot of companies out there that do things similar to this, but this is one of the better ones I've seen in a very long time, and we're making that available to all of our clients. It's a great tool to keep you on track. It's not overly complicated, and it takes some work to it. And I think that the biggest thing, the most effort that is required, is that when you set up your accounts, the credentials that you put into this to be able to access the accounts continue to change as the securities procedures change at the underlying vendors. vendors. So when they change their security protocols, you just have to go in and update it. And that's the bottom line. It's pretty easy most of the time. Not always, but most of the time it's pretty easy. And you go in, you make the changes, and you're good to go. And I really like the ability to track spending. It's actually a little spooky. I should have bought stock in Starbucks. I wouldn't buy it now, by the way. Starbucks is not it's not an undervalued stock. And since I brought that up, again, we're going to be talking at the workshop about Stock Picking 101. And remember when I was talking about earlier in today's show, there was a bunch of Nobel Prize winning economists got together, started a fund, tried to make predictions. They found out that they weren't very good at predicting. They ended up losing a lot of money at some point in time. And then they decided that, well, we're going to still make the predictions, but we're going to wait for the prices to start moving in that direction. And then they went on to make big bucks. So if you apply that to stocks, here's what I'm looking at. Avis, the car rental company. Tough business. Profit margins are not very high, can be not very reliable at times. They're always buying and selling cars, taking care of the insurances. It's a highly competitive environment, all that stuff, right? So it comes up on a scan. It was up 7.74% on Friday, on volume that was above its average daily volume. This stock's at $34. The price to sales ratio on it is 0.33, which is low for just about any company. The average in the S&P 500 is 2. So if you're 0.33, now there's a reason for that because, again, all the things I mentioned earlier, car rental business is very competitive. It's very tough. Profit margins do swing pretty wildly, but here's the deal. If this stock doesn't go well, this is one that I would be selling, probably right around $29 or so. So a little over 10% below where it is right now. And if you just wanted to use 10, you could use 7% on this one. Actually, that'd be right around $32 or so. I would just be right back out of it, wouldn't even think about it. Okay. And this is a particular style of investing. It's not like the indexing thing that we were talking about earlier today. That's a whole different style, whole different story. But the reason I bring this up is I have people that like to do this. I like to do this. In fact, I'll probably buy that stock and do exactly what I just told you I was going to do. I'll set my stop about 15% below its purchase price. I'm not going to put more than 3% of my money in it. So if I got 15% of 3%, it's 0.45%. My portfolio fluctuates that much every day anyway. So that's my risk, 0.45%. And at one point in time, that stock today sells for $34. And at one point in time, that stock sold for $67. And if it makes a profit, great. If it doesn't, it's going to cost me 0.45%. You know how many times I can be wrong? A lot. So basically, this is a company that's got a low valuation, makes good sense that stock should be going higher. And in fact, the stock is going higher. The stock was at $40, just a little over a year ago. Goes all the way down to a little over $20. Now it's like right in the middle there. It's at $34. And it looks like it's running pretty fast. And so that's the kind of thing we'll talk about in more detail. I know it's hard when you're driving and you're hearing this stuff. So don't worry about it. We'll be making videos on this stuff. We'll be going over it at the workshops. And this is not something that I think you should do with a lot of your money, by the way. I don't do this with a lot of my money. As I told you, I have less than 3% of my money in this one stock. But I do it because I like it, because it's fun to me, because it's been profitable over the years. And that's why I do it. So not that you should. I think actually most people probably shouldn't. It's difficult psychologically to do what I'm talking about doing. Most people should be doing the things that we do with the vast majority of people's money and try to spread it out in all the big asset classes. Try to get representation there to the ones that are the most resilient, the ones that bounce back quicker. And depending on your age, you should have a higher percentage into those that bounce back quicker. Because as you get older, it's great to make a lot of money, but if you're going to be down or have a negative multi-year time period, you can't really afford to do that. So you need to go into more defensive asset classes like large companies that pay dividends. That's a particular asset class. So we would call that large value. Okay, you need to have a heavier exposure in that, in my opinion, when you get older, because those things happen to bounce back, or at least have bounced back quicker. Now, there's a fundamental reason. Remember how I first started talking about in the show about correlation and causation? So you'd look at the correlation and say, hey, yeah, when the market goes down, these stocks tend to come back first. That's correlation. Well, why do they come back first? That's causation. And the cause is when a $50 stock, oh, shoot. Well, you can call me and I'll give you the answer, and I'll follow up next week with the answer to that question about the causation on dividend-paying stocks bouncing back faster. Anyway, I got to run. You've been listening to Bill Bullington here on 1420 every weekend from 11 to noon. Have a good week, everybody. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com. Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.